welcome to your Monday Futures Market Outlook for April 4th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles the market has gone through. Back in late 2009 into 2010, we bullishly crossed above that 80-week moving average and have remained above so ever since, giving a bigger picture bullish indication. While we certainly do not want to dispute the bullish trend that's in place, we do want to recognize that at some juncture we are overdue for a healthy profit-taking cycle. Now, we don't necessarily believe that will actually even begin this month or going into May, but at some point, probably in the late second quarter, going into the third quarter, we should start seeing some topping formation somewhere at or below the 1400 level, which would be, again, probably a good, healthy 10 to 15% market correction on the downside. That will probably see even the 1200 level going forward. Now, really at this juncture, we don't, again, necessarily believe it's going to happen now, so we're just going to let the market trend that's in place continue to grab hold, and then we'll revisit the topping formations probably over the next month or two. When we take a closer look at that S&P 500 on the daily charts using the futures contracts, we had that 5 to 10% market correction that occurred going into mid-March, and then subsequently had a V-shaped recovery, making it all the way back to its previous highs. We continued our forecast for the year, had this zone in the 1340, 1380 area where we anticipated the highs of the first half of the year to come in. We probably will have a really solid test into that zone. There is even a measured move that targets the 1410 area on the upside, but we do not anticipate a full measured move higher, as usually the tail end of these types of rallies loses momentum and shorter moves tend to emerge. So we continue to favor the idea that the market's going to really be contained to this 1340, 1360, and then 1380 area targets for the upcoming weeks. Bigger picture, beyond short-term bullishness, that should continue to solidify the topping formation that should happen during the second quarter of the year, and then subsequently going into the third quarter, we should have a bigger picture market correction, but there's no need to try to forecast that on these right now. We'll deal with that in about a month. Just to review our key points, there's no denying that the intermediate bias is bullish and the market continues to remain in trend. We have been anticipating and continue to anticipate a topping formation to probably occur within the next 50 to 60 S&P points higher. But for now, and that's in the bigger picture of trying to create a big topping formation, but there's no need at this moment to become bearish on this market, as more than likely more dramatic selling will not emerge until probably the third quarter of the year. So right now, continuing to stay in trend is still the trade. When we take a look at that NASDAQ 100, we can see that it's now retesting a key line around the 2350 area, but overall even the NASDAQ should come up for a solid double top retest along the 2400, if not finish moves to 2450, even 2500 on the upside. Those are all reasonable targets for the NASDAQ if the market remains in this bullish trend. Now, there is always the chance on both the S&P and NASDAQ that we see double top formations occur as they retest those higher zones. But with the Dow having now broken to new highs, it's more than likely that the market should at some point be able to push through those previous highs. Next year, I want to take a look at the US dollar index futures, and any of our students know the importance of watching the currency as a basis in these key intermarket relationships. We continue to test an absolutely crucial 75.50 support line that has contained all the selling for so far this year. But we continue to see technical deterioration in the US dollar index. If we see the euro breaking solidly above 142 and this dollar index breaking below the 75.50 area, might see a drop down into the 74 or even 73 levels on the downside. This would be the grounds from which commodities can actually make higher legs, and certainly would give the stock market a little bit of a push further. Next here, I want to take a look at copper futures, and we continue to see copper sort of being far more range bound in this sort of channeling formation. Whether you channel it sideways or downwards in that slope, the copper needs to make a committal move here. If we, so long as the U.S. dollar is weakening, we still cannot rule out the possibility that copper is going to come back and retest that 455, 465 level on the upside as it rolls up out of this little consolidation. But if we see at any point some strong U.S. dollar strength and any technical breaks below 410 on the downside of copper, we have to start considering that this could be one very big topping formation that's rolling over already. But there's no indication of that just yet. Next here, I want to take a look at gold futures, and gold futures contracts continue to find significant overhead resistance levels around this 1420, 1440 area on the upside. But overall, it still looks like there might be enough momentum to break this to a higher high. We continue to watch those levels around the 1440. If we have gold make any solid breakout above that, we could see targets as high as 1480 and even 1540, 1550 on the upside. We don't necessarily anticipate this to be a very strong squeeze higher, so I think the 1480 target on the upside is a reasonable one for traders to be focusing on if we get a break above 1440. Next here, I want to take a look at crude oil, and crude oil continues to strengthen on the upside with a very bullish break above all its previous highs on around that 105, 106 level. At this stage, the measured moves even target as high as 115, 120, and the momentum that crude oil has could certainly carry it in there. Shorter moves target around the 110 to 112 area, but we're certainly focusing on 115 on the upside is a realistic expectation if the momentum that has been set in motion maintains itself. So right now, crude oil stays bullish. It would take a catalyst like a conclusion to the geopolitical concerns in North Africa and Middle East to either taper off, or a very strong U.S. dollar short squeeze on the upside to really halt crude oil's advance. Finally, I want to take a look at the 30-year Treasury notes, and the Treasury bonds continue to start consolidating. We have overall seen a couple attempts for Treasuries to break out on the upside and consolidate. The expectation is that Treasury bonds should sort of find it difficult in this consolidation period with a number of false breakouts, but eventually, as the U.S. dollar bottoms over the next couple of months, and commodities get very toppy, we could see a Treasury bond rally that could see 126, 128, or 130 on the upside, but that doesn't necessarily have to happen on the short term. That was your Monday Futures Market Outlook. Thank you for joining me.